Hey, welcome everyone. Trying to get a sense if we have anybody else has joined us yet. But I am going to assume there are people on, and so we'll get started. Welcome today. We at Smart Growth are grateful that we're going to have a couple of experts from SVA, Certified Public Accountants, to talk to us about opportunities under the One Big Beautiful Bill. Specialists in real estate and tax, Ted Ibinger and Rhett Reuter. And we're going to, if you have questions, during the course of their presentation, feel free to write those down in the webinar chat. But what we're going to do is save answering the questions until the end of the program to allow Ted and Rhett to get through the material. So without further ado, we're going to let Rhett get started on the program, and he'll be followed by Ted. Thanks, Rhett.
Yeah, thank you, Bill. Hello, everyone. My name is Rhett Reuter, like Bill said. I will cover some stuff here, but before that, I would like to make a note that the One Big Beautiful Bill Act is quite the mouthful. So going forward, we will be referring to that as OBA. So if you hear OBA, we're talking about current law, and then Tax Cuts and Jobs Act was the previous law, and that will be referred to as TCJA, as shown here. So first, we're going to talk about individual tax provisions in the TCJA that were made permanent. So you can see here we have individual tax rates that were listed here. These were set to expire after this year. However, under OBA, they have been made permanent. If they were not to be made permanent, at the end of this year, the highest tax rate would have been 39.6% starting next year. But again, those rates of 10 to 37% have been extended. The income thresholds within each percentage will be indexed for inflation starting after 2025. Standard deduction and personal exemptions. Again, the standard deduction was increased under TCJA and was set to revert back to the old levels after this year. Personal exemptions were suspended under TCJA and were going to be reinstated after this year. Neither of those things are going to happen. So the increased standard deduction has been made permanent and the personal exemptions have permanently been terminated. So we're going to still, be under those higher standard threshold or standard deduction amounts and not have personal exemptions going forward. Next, we're going to talk about various credits and other things that have been made permanent. So the child tax credit was increased under TCJA from $1,000 to $2,000. It was set to revert back to the original $1,000 after this year. However, OBA has made that higher amount permanent and also increased it 10% to $2,200 per qualifying child. And they have also permanently increased the phase-out thresholds that are noted here as well. TCJA introduced a new other dependent credit, which is $500 per qualifying dependent. So those are those people over 17 years old. That was set to expire after this year as well. However, it has been made permanent and will still be available with some additional requirements for residency, some additional tests, but the credit itself still exists. AMT under TCJA, it increased certain exemptions and phase-out thresholds, which made it where less taxpayers, were subject to AMT at all. And good news, those have been made permanent as well. One of the bigger changes, and I think good news, is the estate and gift tax exemption. It was set to be close to $14 million in 2025 for the lifetime exemption. However, it was set to revert back to $5 million after this year. Good news is that has been increased to $15 million starting in 2026 and made permanent. So there is no sunset of that increased lifetime exemption. However, I would say if you're already doing estate and gift tax planning, that you continue on because there can be other benefits to doing so, but this will give you a little bit more runway and leeway to make sure you're doing what you want done. So how this can impact you, really it's just reduced tax rates, increased credits. So most taxpayers that aren't subject to the phase out are going to see a reduced tax burden, and that's all good news. And with the estate and gift tax exemption, it really allows for future wealth transfer planning. Still look to do the planning, but it gives more time for professionals and yourself to kind of get what you want done. Next, we're going to cover itemized deductions. And so the first itemized deduction that had some changes is the state and local income tax cap. So under TCJA, the SALT limitation was $10,000. So that would include your state income tax and your real estate taxes. All taxpayers were capped at $10,000. Now going forward under OBA, that cap was increased to $40,000 and will have a 1% escalator until it expires after 2029 and reverts back to the original $10,000 cap in 2030. There is a phase out if you make more than $500,000, but never to go below the original cap of 10,000. So everyone will get 10,000. Some that are under that threshold will get an increased cap up to 40,000. With regard to mortgage interest deduction, TCJA limited the amount of interest or amount of debt you could have for the interest to be calculated on at $750,000. That cap has been made permanent, but does include, there was some changes to mortgage insurance premiums being included going forward. Next, miscellaneous itemized deductions. Those were suspended. So those are the deductions that were subject to a 2% of AGI floor. Those have been suspended, and that suspension from TCJA has been made permanent, so those no longer exist. There was a piece limitation before TCJA that was suspended. That has been permanently removed under OBA. However, there is a new cap on itemized deductions for those individuals in the highest tax bracket. They will be limited in the deductions they're able to take. And so keep that in mind. And then for charitable contributions, for those that itemize, they're in parentheses. Previously under TCJA, they were just subject to certain AGI limitations based on the type of contribution, whether it be cash, stock, things of that nature. Those limitations still exist, but OBA has also introduced a new 0.5% floor that you have to get over for those high income earners. And so a simple example is if you have $1 million AGI, your first $5,000 or 0.5% of the million would not be deductible. You'd have to have, $5,001 of charitable to get a $1 deduction added to your itemized deduction. So that will impact those individuals. Moving on, talking about how this might impact you. With regard to the state and local cap, really it might allow for you to do more bunching again. Pre-TCJA, if you were straddling the line between, I'm really close to taking the standard deduction or itemizing, you might have considered bunching real estate taxes in 1 year. So pay 1 year in January and the next year in December, so you have 2 real estate tax bills paid in the same calendar year to really push you up into that itemized deduction. Now that we're not capped, that might be an opportunity again. For the charitable, I think it's going to result in a lot of individuals trying to pull additional deductions into 25 to avoid the cap. And one common tool that you'll be able to utilize to bunch those charitable donations would be a donor advised fund that allows you to set up a trust account to put your money into. You get the deduction this year when that fund is funded, but you can make donations from that fund into the future, and any earnings in the fund grow tax-free as long as they're used for charitable purposes. And then lastly, a QCD, which is a qualified charitable distribution from IRAs, may still be a very tax-efficient way for those individuals that it applies to avoid income recognition for those distributions from your IRA and also not be subject to this contribution floor. Next, some new items that were contemplated in OBA. The first will be this charitable contribution deduction for non-itemizers. So historically, you would only get a charitable contribution deduction if you itemized. Now they're breaking out an additional above the line deduction for those that take the standard deduction. And so that will be $1,000 for single filers and $2,000 for those that are married filing joint. This is a permanent provision, and it starts after this year. So 1/1/26 and on, you'll have the opportunity to do this, but does not include the donor advised funds that we talked about earlier. So contributions to those funds do not qualify for this above the line deduction. Next, we will cover enhanced deduction for seniors. So this is trying to accomplish President Trump's campaign promise of having no tax on Social Security. So previous to OBA, under TCJA, seniors, those over 65 did qualify for an additional standard deduction, as noted here. Under OBA, the bill adds a $6,000 deduction per individual above the line. And that is in addition to the additional standard deduction that it noted under TCJA. So they'll get both. This is a temporary provision only for 2025 through 2028. It is subject to some AGI limitations as noted here, but hopefully this does help those seniors reduce their tax on Social Security. Next is an auto loan interest deduction. Nothing of this nature has ever existed. So under OBA, it allows for up to $10,000 to be deducted on, auto loan interest. This is a temporary provision again. It's only for a 4-year period. It includes all qualified personal passenger vehicles with final assembly in the U.S. So that's a important caveat. The final assembly has to be in the U.S. This does include ATVs and UTVs, and is subject to a phase out again, 100,000 for single filers and 200,000 for those that are married filing joint. It must be a new car purchase, and so maybe this will apply to you, maybe not, but this is something that was introduced. And then lastly, under the new items is just how this will affect you as taxpayer. For auto loan interest deduction, if you're considering buying a vehicle, making sure that it's assembled in the U.S. might be something worthwhile. And then also just working on ways to minimize your income in a year, potentially, if that's an option, so that you don't go over those phase outs, because the most interest you're going to pay is in those first few years. So if you can income shift out of those first 2 years to get the deduction, it might be beneficial. With regard to the charitable contribution deduction, it's going to be important that people that historically have never had to track them, because that can be, $2,000 deduction, could have some potential significant tax savings for those individuals. So working to make sure that you're keeping track of the donations that you make throughout the year could have some benefit to you, even though you might be a standard deduction user when it comes to year end. So keep that in mind. Next, I want to kick it over to Ted to cover some compensation and benefit items. Kick it off, Teddy.
Thanks, Rhett. Appreciate it. And welcome, everyone. Thanks for joining. Our first slide we're going to talk about, Rhett just mentioned a few slides ago on Social Security and those changes. I think one of the big ones there was we didn't get Social Security to be not taxable at all. And if you've seen something in the headlines, you've probably seen maybe 3 items that might have, stuck out to you right away. And that was Social Security, and then tax on tips, and then overtime as well, since that's been talked about a lot. And that's what President Trump did campaign for as well. So a few items I want to point out on this slide. So what's important in this category, and it's the same as Social Security, is it's 2025 to 2028. That's what it is right now. Who knows what will change in the future? We've had stuff extended and permanent, but as it stands right now, it's only in that time period. I think the other big one on this slide is those 2 of the last 3 bullet points. That is the highly compensated employees. for the wages, and also phase outs to watch. As Rhett noted in a couple other slides for these individual tax rates, those phase outs are big for 150K if you're single, or 300 for married filing jointly. So something to consider, where just because they say, oh, it's no tax on overtime or no tax on tips, well, your AGI and your income still comes into play on that. Now we'll get in on the next slide into some specific items related to what does this look like. And then we'll talk about the future after this, and some items to consider for employers that are on this call as well. So before the TCJA, none of these, or both of these items were not included at all. So this is new with OBA, so brand new when that starts. And on the W-2, it's for 25,000 for both of these, as you'll see the first bullet point listed. Obviously, that last bullet point for tips is important. It's where tipping is traditionally customary. You can't just create that now because you have this new threshold. So really want to point that out as well. And then with the overtime, same thing. It's only the premium portion of the overtime. You might have people that might want to try and get around that, and what can they do to that. But just wanted to point out a couple of those and how that is defined in that Fair Labor Standards Act. Now we'll go to the next slide of the future and how that impacts businesses and what that looks like for an employer. Well, the W-2 did get more complex. We don't know what some of these changes are exactly going to look like now, but what is going to be required is to have these stated separately now going forward, so they're clear. It isn't on the employer side, it is on the employee side, because it comes into the income limits if you can qualify to not have that tax. So keep that in mind. You're probably going to get questions related to employees of what that looks like and how does that impact them. And then the last point too, for that FICA tip credit, it doesn't have an effect on that if you are someone that qualifies in this group. Probably doesn't come into play. But I did want to point that out, as these are a couple of the hot topics that were in the new bill. Next up, we are going to go into discussing 1099s. So a great change here, 1099K. The threshold's $20,000 is what it is. That changed in 24 under the TCJA to $5,000. Huge administrative burden for companies. And then that was supposed to change to $600. Well, what happened is we got back to the $20,000 for the 1099K, which is awesome. Less reporting, less issues with 1099s on that. And I would say the biggest impacts is the 1099 NEC and miscellaneous, and you'll see those in the last two boxes on this chart. Good point about this. It was $600, and that's what it's been, I think, for like 72 years. And that was never indexed for inflation before. Well, now beginning after 2025, so keep that in mind, 12/31/25, it's the, so 1/1/26, it's going to change to $2,000 for both of these, and we will have that index for inflation. So we're not going to have these same numbers that have been there for 70 plus years. Great change for businesses. A lot of time spent tracking down EIN, social security numbers when you're paying vendors, getting that set up in your system. And not having to do the $600 is a great change. We'll have that index for inflation, so very positive there. We're going to go into the next slide now, which we'll talk about also the employee retention credit. So also known as ERC. This was big, remember, with COVID. You had two plans that were introduced, one PPP program, the second one ERC. Well, what the TCJA did and in COVID was we had some credits that essentially you had to file a 941X to receive the credit. There was a refundable and non-refundable portion, and you had to meet certain tests, which the slam dunk was a reduction in revenue, and that changed between quarters in 2020 and 2021 for what that percentage drop in revenue was. And then we also had, if you were a government order or mandate where you could not be open, you could qualify as well. Just wanted to go over those just baseline items. So now we have this change, which is if you did not file the claim before 1/31 of 2024 for Q3 and Q4 of 2021, you can no longer do that. This was thrown out there in the last year or so when we thought we were going to get some technical corrections and some updates to the tax bills, but nothing ended up happening in those years. So from the accounting side, we knew for our clients that that was coming, and we let them know to make sure we filed those as we could. And with that, I think there's a big one there is if you are someone that did do this program, it took a significant amount of time to receive the payment. A lot of this with the IRS was very slow with them filing paper returns and actually getting the payments. I had a client just last week, they filed 2 years ago, and I think they just got their payment. So it's definitely been a long time to get that. And I think it's good now that companies have got that. But if you're in that boat, just wanted to bring that up. The other point to point out is that last bullet point, it extends the statute of limitations 6 years. And this was something that they wanted in the bill because there has been a lot of fraud with this program. You might have seen some articles or headlines related to that as well. People filing fake 941s, et cetera. So that's why they extended this program, because there's been a lot of issues with it. All right, now we're going to talk about the future for both of these. I did point out already 1099's great change for businesses, very positive with that index for inflation. So we like to see that one a lot. And then also that audit period for the ERC, keep that in mind. You want to make sure you're keeping these 941Xs at least 6 years. We always tell people to keep stuff for 7 years for returns in case something comes up. Remember, if you do get audited before that period's up, it might extend past that period. In cases the IRS would ask to extend that, a lot of times it's just what happens depending on when your return gets pulled. So keep that in mind just to keep those returns so you have them. Next up, we're going to get into some business changes. A couple big ones here as well as we get into bonus depreciation. So old rules, TCJA, we had phase outs. We had 100% bonus depreciation for some of those tax years in there. But then what happened is we had a 20% phase out starting each year in 2023. So as you can see on the chart, it was going to go 80%, 60, and then in 2025 we would have 40% bonus depreciation. Well, now we have 100% bonus depreciation. That was made permanent with OBA, and that's for property purchase after 1/19 of 2025. I do want to point out just a few items with this. There was a lot floated around that we thought we were going to get corrections when we had these 20% phase outs. Well, that never ended up happening. So we did have a couple years of those phase outs. And the second one that I do want to point out on the bonus depreciation is you'll see that date, which is similar to the TCJA date there of 9/27/17. Well, you do need to just watch that with contracts entered and what you have, as that might be an impact of whether you qualify for bonus depreciation or not. If you do have questions on that, feel free to reach out to Red or I, whoever your accountant might be, just to see if you qualify and what that looks like. Because if you had something purchased before 1/19, well, you're going to be at that 40% bonus limit for 2025. So I just want to point that out, and that's something that's on your radar. Next one, what we have is business interest expense limitation, and this is under section 163J. I think Rhett would probably agree with me on this one. This was probably our least favorite change in the TCJA, and this made it a little complex in the case if you're a real estate entity or what you have. So basics, what happened was business interest expense was limited to 30% of what they called adjusted taxable income, or ATI. And with that, we had certain years of limits. So 2018 to 2021, we essentially had EBITDA is what our limit was. So that's earnings for interest, taxes, depreciation, amortization. Well, in 2022 to 2024, that actually changed, and we lost depreciation and amortization in that calculation. Um, and now we go to what happened with the OBA is that reinstated depreciation and amortization. So great change to bring that back if you were subject to those limits. I do want to point out a couple things, and one would be the small business exemption threshold. So when that came into play with the TCJA, that amount was $25 million. So if your prior 3 years of gross receipts was greater than the $25 million, well, you were subject to that limitation. So yeah, we have a lot of small businesses that you were under this small business threshold. You're not subject to that. Well, we now have a change in that amount, which is 31 million for 2025. So that changed, and that's going to change for index for inflation as well. But I do want to point out to this group too for some real estate entities. So when this came out, you could make a real property trader business election, and you could essentially not have to follow these rules. But what happened was you had to change your depreciable life if you're a residential building from 27 and a half years to 30 years. So we ran a lot of scenarios with our clients of, well, can we or should we make this change? What's the bigger loss, depreciation or interest? And one other item I do want to point out, if you are non-residential real estate in there, if you did make the change, then you're not subject to, or you can't take bonus depreciation. So that's another one on some of those improvements for the qualified improvement property that I'm going to get into in a few slides coming up. So that election though, too, just so you know, it was irrevocable. And I do want to point that out because it is a way where you can get around some of that to still be able to deduct that. Because with that small business threshold, we ran into some items where if you were considered a tax shelter, you didn't qualify. So we had some limits there that got pretty complex. So as you can tell, that's why it's one of the ones that we were not a fan of as we were doing this when this originally came out, the TCJA. And then on the next slide, we're going to get into one more provision as well that we had to change, which was the excess business loss deduction. This is under section 461 if you've crossed this. And essentially what happened is your business losses in a year when this came out in the TCJA, if they're over $500,000, you were limited and you couldn't offset other income that you had, whether that be, your W-2 wages, interest, dividends, etc. So you could only offset business income. With that 500K, that's the married filing jointly threshold there. And so if you got into the limit in year one, well, in the subsequent year, that went to your net operating loss, and then you could offset that. Well, now what happened was with the OBA, that is permanent, and it keeps the same treatment. You have that there. It's just we have a threshold change for inflation, and I believe that's right around $620,000 for 2025. And that's going to change every year for inflation as well. And this was another change that was a little bit of a frustration, especially if you're a real estate entity, you were taking some bonus depreciation. You couldn't offset just every income the start of the year, just like how it was prior to that, to just create an NOL. Next, what I'm going to discuss on this slide is qualified business income deduction. So QBI deduction, this was new with the TCJA as well. This is your 20% deduction on qualified business income if you qualify. And that was set to expire in 2025. Good thing OBA made this permanent. We have phase out ranges that also have changed and are indexed for inflation. And that will continue to be indexed for inflation as well. If you did see any probably news articles when it went back and forth between the original House bill and the Senate, the House bill did try and change this QBI deduction to 23%. That didn't go through in the final bill that was approved by the Senate. So we're still at 20%, which is the same that we were at in the TCJA before as well. All right, now going forward, we'll just do a quick recap of these four sections that we just went over and how does that impact you. Obviously, the first one, bonus depreciation, great that it's 100% made permanent. I'm going to talk I'm going to touch in a couple slides on 179. So we'll talk about some differences between bonus and 179 when we get there and you see the phase out limits. Business interest, expense, deduction, great that we are adding back depreciation and amortization again. Great taxpayer friendly change. Excess business loss, like I just discussed with the House bill, great spot that we're still at 20%. We didn't have some of the changes that the House bill wanted to make that more complex and not as taxpayer friendly. So great change there. QBI, still great that it's at 20%, that it was set to expire since that was new with the TCJA. So another advantage for business owners there too. Now we have some additional business items we're going to get into on the next slide. And the first one of this is going to be section 179 that I kind of just mentioned on that prior one at the bonus depreciation. And we'll do a quick compare and contrast on this as well, just for your summary. So 179, as you can see in that middle chart, 2023 limit, it was right around 1.2 million. And the phase out, so once you're over about 2.9, you were phased out of that 1.2 million you could take. And you'll see right there what that property included. And we're going to get into some specific items in a couple slides as well that will clarify that a little more. But what we have now with OBA and 2025 thresholds, well, as you can see, that limit almost doubled. We're at 2.5 million as the amount that we can expense in 25. And the phase out's 4 million. So for property over $4 million that you do buy, you start getting into some of these phase out ranges if you can take the 179 amount. So keep that in mind. But it is great that we have that amount expanded, and that will change and index for inflation as well, that on some of the other slides that Rhett and I made the comment as well. And this is effective right away for 2025. You will see that qualifying property there as well. Personal property, off the shelf software, qualified real property. We'll get into that as well. But you're buying equipment, computers, anything like that. If you do qualify for that, you can take it. And now next we're going to go, what does that look like with qualified real property, and what is that? So with the TCJA, we got into we kind of condensed some of the categories that we had, as you'll see on the right side. This qualified leasehold improvement property, qualified restaurant property, qualified retail improvement property. So we have a lot of definitions here of what does that look like. It's very similar between TCJA and OBA for how that is. I'm just going to break down a couple for you right now, and then we're going to get into bonus versus 179 on the next slide after that. But what I want to hit on this slide is, yeah, we have the code sections there. That gets a little heavy, but what I do want to say is, well, what is qualified real property? What is qualified improvement property? And what those two categories are is where you can qualify for 179 deduction is roof, heating systems, fire protection, alarm, security. And then you also have the qualified improvement property, which is going to be interior improvements to non-residential building. Think of it that way, as you're not enlarging the building. And then there's a couple carve outs as well. It can't be internal structural framework. And then escalators and elevators also don't count. But if you're in those categories, that 179 expanded with the TCJA, and we're at the same spot with OBA where we have those deductions. Now, next up, we have 100% bonus with relate to qualified production property, which was brand new in the OBA bill. And what I want to just take a step back now and kind of discuss on what we have is, well, with this bonus depreciation versus 179, if you don't have taxable income, you can't take 179. So that's where bonus depreciation comes into play more. There are certain entities that can't take 179 on certain property, and one of those being your real estate businesses. You'll take bonus and not 179 unless you are in one of those carve outs of qualified improvement or real property. So just want to point that out of how you qualify there. And where bonus depreciation, what happened now in this new bill as well is we have a new introduction of property, as it wasn't complex enough for them to break down all of these other qualification property categories. Well, now we have what is called qualified production property, and that's going to be your non-residential real property. That's manufacturing and production. And you do have to have substantial transformation of the property. I will say in there too, you have the specific dates. So that's going to be your January 19th date of 2025. But that has to be placed in service before January of 2031 as well. It does exclude a couple pieces as well, like some lodging, parking, sales, R&D, etc. But that is a new one. I think they're trying to stimulate some manufacturing production in there, and that's why we have this this new category that was introduced with the OBA bill as well. Next up, we have our last one for business items, and I just want to touch real briefly on meals and entertainment. So TCJA back in 17, what happened was you could no longer deduct entertainment. We still were able to deduct 50% of meals. We did have some years in there as well where we had some changes due to COVID, where there was some different categories and carve outs of what that looked like. And what OBA did was it did retain the 50% for meals. You'll see that listed there. Obviously, can't be lavish. You have to have an employee present. There's some of that. And entertainment is still not deductible. What I do want to point out on this is Wisconsin actually allows you to deduct 50% of the entertainment cost still. That never got changed with the TCJA there. So you could have a different, essentially a subtraction on your Wisconsin return that you get a deduction for that you're not going to get on the federal return. So just something I want to point out there. We'll go into the next slide now, and we'll just do a quick recap. So we have the enhanced 179 and bonus depreciation. We have the new categories that exist now, which is great. Taxpayer friendly, good changes that we did receive with those costs increasing that you can deduct in the first year, then also back to that 100% bonus, and then the qualified production property qualifying as bonus as well. And then the meals, you still have 50% of deduction there on your federal return, which is great. And then the state difference that I did just mention. Next up, I am going to turn it back over to Rhett, and we're going to have business taxes. He's going to go into some specific items as
well. Hello again. Go over some business tax modifications that were noted in OBA as well. First is the qualified small business stock exclusion. So this wasn't necessarily a TCJA item, but it was, pre-OBA. There was, an eligibility requirement for the stock to be allowed to be excluded, or the gain on the stock. And those requirements were that the stock had to be acquired at original issuance, not a secondary market, issued by a domestic C corporation. That corporation had to have gross assets equal to or under $50 million. And the corporation must be engaged in an active qualified trade or business. OBA didn't change really any of that, other than the gross asset test for the corporation was increased from 50 million to 75 million. So that's helpful to a lot of corporations. Next, we'll go over the holding period requirements. And so under previous law, if the stock was held for more than 5 years, you got an exclusion of that gain dependent on when you acquired the stock. And so as listed here, there was a 50% exclusion if the stock was acquired before February 17th of 2009, 75% for the between February 18th and the September date, but then 100% exclusion for stock that was acquired after 9/27/2010. Under OBA, I think it's going to be a little bit more easy to follow, and it's just a tiered gain exclusion based on your holding period. So if you buy stock, you hold it for 3 years, you get a 50% exclusion. If you buy and you hold it for 4 years, you get a 75% exclusion. And anything 5 years or greater, you get 100% exclusion. With regard to what exclusion is allowed, under previous law, you could your excludable gain was limited to the greater of $10 million or 10 times your basis in the stock. Under OBA, they've increased those exclusions to the greater of $15 million, which will be adjusted for inflation. The 10 million never was. So now it's the greater of $15 million or 10 times the taxpayer's basis in the qualified small business stock. Keep in mind the new rules apply to stock if it was issued or acquired after enactment date, which was July 4th of this year. And also keep in mind that if you have a stock for stock exchange or a rollover, those do not reset the acquisition date for you to qualify for the new rules and exclusions. Next, we'll talk about opportunity zones. So while qualified opportunity zones were new in the TCJA, and what they did was allow you to defer capital gains by reinvesting that gain into a qualified opportunity fund, or a QOF as they're referred to. Those gain deferrals lasted until the earlier of either the investment in the QOF was sold or December 31st of 2026, or the end of next year. Additionally, once you invested in a QOF, you did get a step up in basis, which essentially gives you partial forgiveness of your deferred gain. And how you got that was if you held it for 5 years, you got a 10% basis increase. If you held it for 7 years, greater than 7 years, you got an additional 5% basis increase. Now under OBA, the gain deferral is the earlier of, again, still the investment being sold or exchanged, or now it's a 5-year date from when you made the investment. So, you only get at maximum, you're going to get a 5-year deferral when you invest in a QOF. With regard to step ups, again, the 10% basis step up does apply if you hold it for more than 5 years. The additional 5% has been eliminated. So the max bonus, or the max step up you can get is 10% for 5 years, unless there's a new one, a 30% basis step up after 5 years for those QOFs that are invested in rural areas, which was defined as a population less than 50,000 people. So they're really a common theme you'll see in this area of my presentation is a really big emphasis put on rural investments. They're trying to push rural investments. And so a lot of the new credits or, OBA is really pushing that. So that'll be a common theme that you'll hear from me over the next few minutes. Next, I think maybe the biggest thing other than the gain deferral is the fact that the qualified opportunity zone, program allowed you to have this exclusion of post-investment gain. So if you hold the investment for 10 years or longer, any appreciation in that QOF investment is entirely tax-free. And so that is a huge benefit if you hold it for 15 years, and any appreciation you had after that initial investment is now tax-free. The qualified opportunity zone was set to sunset at the end of next year. However, now OBA has changed that. The exclusion of post-investment gains still exists. However, the appreciation that you're able to benefit from is capped at 30 years. So I assume, how I see it in practice is once you hit your 30-year anniversary of that investment, you'll get a step up in basis to the fair market value at those 30 years. And then any appreciation after that period will then again be taxable. The sunset is permanent, or there is no sunset. It is now permanent law, so you don't have to worry about that ever going away until potentially a new president takes office and changes everything. But for now, it's there. Next, we are going to cover new market tax credits, which again is not as significant. There was no significant change to the program. However, when you see the eligible areas, there's going to be an emphasis on rural again, and they're really wanting to emphasize that you stack programs. So if you're able to do opportunity zone with new market tax credits, with low income housing tax credits, that may be a way to kind of get some of these rural projects off the ground that otherwise wouldn't have been able to be feasible. And really the biggest change for new market tax credits is we made that permanent. There's no sunset risk for now. With regard to low-income housing tax credits, again, no real huge changes to the program. However, the 9% credit did get an increase in the allocation. So each state agency will get a 12% increase in the credits allocable for that program. So hopefully will lead to more projects being done. And then with regard to the 4% deals, the bond test that used to be 50% has now been reduced to 25% for those projects that are done after 1/1/26. And so really, how does this impact you as taxpayers? With regard to the QSBS, it really just gives you greater flexibility for exit timing. Now you can get at least partial exclusion for those stock that are held for 3 or 4 years, whereas previously you had to have it 5 years to get any exclusion. There's a larger tax-free gain potential here with the increased cap and the fact that that's now being adjusted for inflation. More corporations will qualify for the exclusion now that there's a larger asset cap and there's no AMT preferences, which could have had unintended consequences. So that's a good thing as well. With regard to qualified opportunity zones, just more certainty now that they're permanent. They don't have that sunset risk. There's an enhanced step up for rural areas. Do keep in mind that there will be new census tracts or qualified tracts published to be used in 2027 and beyond. And so if you currently have a project that you're looking at or land that you're holding to develop that is currently in a qualified opportunity zone, you may want to consult your tax advisors or, think about maybe moving a project along, because there's no guarantee that that area will still be a qualified opportunity zone when the new rules apply, because they're looking at making some of the criteria more strict with regard to income and poverty thresholds. So do keep that in mind if you're looking at doing a project now, that you might want to move it along faster if you can to benefit from this program. And then one other downside is there's going to be significantly more reporting requirements going forward with substantial penalties for noncompliance. Previously, it was kind of a lot more self-reporting. There's going to be a lot more IRS compliance that's going to apply in the future. With regard to new market tax credits, again, just really added certainty for developers, investors with making that credit permanent. Hopefully more capital from investors because of that. And again, like I had mentioned before, with this rural focus, I think Congress and the president is trying to encourage stacking of credits and different programs to really make some of those projects feasible. And then with low-income housing tax credits, overall, I think both changes will just hopefully lead to an increased access to credits and more projects being developed to meet the need. Next, we're going to cover energy provisions, and really OBA, for lack of better words, took an axe to some of the energy efficiency credits that were either put in place with TCJA or the Inflation Reduction Act. I'm not going to go over all of the energy provisions that are either being removed or changed in a way. I try to focus on the two main ones that I knew would affect some developers and those in the real estate industry, and that being the 179D deduction, not a credit, but a deduction for energy efficiency improvements. Under previous law, you could get anywhere from a 50-cent to a $5 per square foot deduction for, it would require a study from an independent contractor. There's various firms that do these studies, but they would come in and see, what level of deduction you would generate. This is still technically allowed, but starting in June 30th of 2026, anything that begins construction after that date, next June, will not qualify. So if you have a project that's getting close to starting construction, make sure you got a shovel in the ground before June 30th, 2026, and you might still be able to benefit from some of these deductions. With regard to 45L, this is a credit, and this is where you can get up to $5,000 per dwelling unit as a credit if you meet certain energy efficiency standards and certain fair labor law for the contractors. It still exists again, but now the homes need to be acquired before June 30th of 2026 to qualify. So if you are building something, and if we can push the timeline forward, or you're looking to acquire something and do some rehab, those units need to be placed in service before that date to qualify for what can be a very substantial credit per unit. So ultimately, how does this impact you as business owners or taxpayers? With regard to the energy provisions, it's really just paying attention to project timelines so that you can try to get things placed in service or construction started before those credits and deductions are set to expire, because those are going to have some significant benefit to your taxable income. And I'd hate for a month or two to be the decision or the difference between getting it and not getting it. So paying attention to those deadlines is going to be imperative going forward. So that was the last piece that we had, and I don't see any questions in the chat. So if you have any questions, please chat them to us now. And while I'm waiting, I will go to the next slide and just let everyone know that there are additional resources available to you. Go to SVAaccountants.com. We have a OBA page dedicated to this act. It will cover various biz tips that we're doing, articles that we're writing, all the information that we have gotten and are compiling will be on this website. It's imperative going forward, as we start to digest this law further and forms come out and compliance comes out with how we're going to address it. Those types of things will be addressed here and should be a resource to you. Additionally, if you have any questions after today, the next slide has Ted and I's email on it. Feel free to reach out with any questions you have. We're happy to chat, and try to explain things more thoroughly. I know that we went through a lot of things fairly quickly today, but there was a lot to cover, and we hope you got something out of it. And again, feel free to let us know if you have any questions. Bill, with regard to, will there be a list of vehicle models that qualify as having final assembly in the US? I think it's all dependent on the VIN number, but there should be additional publication by the IRS in the future that will outline kind of how to see what vehicles apply and which ones don't. Yes, I think there's more to come on that. But yes, I think there should be some type of list published by the IRS in the future. So if there's no other questions, on behalf of Ted and I, thank you for joining Smart Growth and SVA for this presentation on OBA. Thank you.